You know, looking at the charts this morning, it really feels like the global markets are finally waking up to a harsh reality. Everyone is realizing that Japan, the world's most indebted advanced economy, might actually be in trouble. For the longest time, we assumed they could just defy financial gravity forever, but it looks like that ride is over. Let's be honest about how we viewed Japan for the last, 30 or 40 years. We looked at their debt burden, which is just absolutely towering at this point. We are talking about roughly 230% of their entire GDP. And we just shrugged. The whole financial world treated it as this strange, harmless little anomaly. It was like this weird quirk in the system. We basically perceived it as something that existed completely outside the usual rules of economics. You know, like the laws of physics didn't apply to Tokyo. But that illusion, that idea that debt doesn't matter, it is fading, and let me tell you, it is fading fast. And the reason isn't just old age or slow growth anymore, it's politics. With the new administration in Tokyo rolling out one of the most baffling, head-scratching fiscal expansions we have seen in recent memory, the big global players are just totally shocked. They don't know what to make of it. Let's look at the specifics here, because the numbers are just wild. Prime Minister Takaichi Sanae has only been in her tenure for about 6 weeks. Just 6 weeks. And in that short time, she has managed to stun investors with this massive stimulus package worth $135 billion. Now, if that money was going into high-tech factories or infrastructure, maybe the market would understand. But it's not. This package is absolutely stuffed with political giveaways. We're talking about things like rice vouchers, and fossil fuel subsidies, and just general cash splashes. When you look at these policies, they really seem designed not to boost actual productivity in the economy, but essentially to mask the inflationary consequences of her own policies. It's like trying to put a Band-Aid on a broken leg. And the market reaction? It was immediate. It didn't take days. It happened right away. I actually posted about this over on my Telegram channel in real time when it was happening, if you saw that. The Japanese bond yields, which you have to understand, had barely budged, barely moved an inch for decades, suddenly spiked violently. To give you some context on how crazy this move was, the 10-year government bond surged all the way up to 1.9%. Now, I know, to an American investor, 1.9% sounds like nothing. But for Japan, that is almost touching levels we haven't seen since 1997. That is ancient history in financial terms. For a country that has lived on ultra-low rates, basically zero interest, for nearly an entire generation, even these small increases carry just enormous, massive consequences. I've been talking to people, and economists inside Japan are genuinely worried. They are saying that the country is flirting with a meltdown style, similar to what we saw with Liz Truss in the UK. You remember that disaster, right? It's that same feeling of the bond market revolting against the government. The thing is, debt service costs. The money they pay just to keep the debt going were already rising sharply even before Takaichi decided to open the taps. But now the warnings are growing louder and louder by the day. It's becoming a roar. If you ask me, all the signs point to one thing: a fiscal reckoning. A real fiscal crisis is ahead. Unless the government refuses to reverse course, which, let's be honest with ourselves, is unlikely to happen because politicians hate admitting they're wrong, Japan is going to face a sudden, brutal loss of market confidence. And when that confidence breaks, it triggers a cascading sell-off. We're talking about a crash across bonds, across stocks, and the yen itself. Everything goes down together. Now, why should you care if you live in New York or London? Well, it will have consequences on the United States economy, too. It's not just their problem. I actually mentioned this in my previous video, which did really, really well. I think it has over 500,000 views right now, so thank you to every single one of you who watched that. I really appreciate it. But back to the point, it will impact the United States economy, as I mentioned in that video, for one very simple reason. Japan is the largest buyer of U.S. debt. Think about that. Washington has to issue and sell debt to finance its operations, to pay the military, to pay for Social Security, everything. That is just how the system works. And if the biggest buyer leaves the market, that is a very, very dangerous game. Usually, in a normal G7 economy that has an independent central bank, when you do massive spending, it means higher rates, and that usually leads to inflows of capital. Money flows in to chase the yield, but that's not happening here. Instead, under PM Takaichi's policies, the yen remains stuck near 155 yen to the dollar. That is hovering close to its weakest level for half a century. 50 years. Investors are looking at Japan, and they are no longer treating it as a safe haven. It used to be the place you put money when you were scared. Not anymore. Needless to say, the yen is behaving more like an emerging market currency. It's acting like the currency of a developing nation. It is very volatile, it is vulnerable, and it is very, very exposed to external pressures. I would go as far as to say that this shift, it is clearly seismic. It's an earthquake in the financial world. You have to remember, for 30 years, whenever the world looked risky, Japan's currency surged. It did really, really well in bad times. Households and big institutions, who are the world's biggest external creditors, would pull their money home to safety, sending the yen soaring. That is what used to be the rule. Well, now the opposite may happen, and if markets continue to lose confidence in Japan's fiscal and monetary discipline, capital would flee the country. Money would run for the exits, pushing the yen down even further. And look at the policy choices here. Instead of tightening their belts, the new Japanese PM has abandoned Japan's target for a primary budget surplus. They just threw the goal out the window. She rolled out a spending blitz that mixes some industrial policy with what is arguably just pure populism. Now, to be fair, some investments in AI, semiconductors, and quantum computing may eventually pay off, of course. I'm not saying technology is bad, but many experts argue that much of the rest of this spending is simply waste. It's just burning money. And frankly, the timing could not be worse. After decades of deflation, where prices never went up, inflation has finally returned to Japan. This is ending the era of zero-rate financing that kept that huge debt manageable. That's the key. The debt was okay because the interest was zero. For 40 years, their annual interest costs hovered around 10 trillion yen. Even as the debt soared to record levels, that cost stayed flat. The equilibrium has never been broken until now. As the older bonds mature and new ones are issued at these new, higher yields, Japan's interest bill is set to rise dramatically. Get this, the IMF expects payments to double by 2030, and wait for it. They expect them to quadruple by 2036. Can you imagine your mortgage payment quadrupling? And that is under the assumption of an orderly market. That's the best case scenario. But the truth is, and we all know this, regime changes like this rarely stay orderly. They get messy. Some analysts are already warning that Japan may soon face choices not seen since its post-war stabilization crisis. We are talking about drastic measures, things like wealth taxes, or even freezing bank deposits. That sounds extreme, but it's on the table. Others emphasize that deeper structural problems do exist underneath all of this. It's not just the PM. For example, Japan's population is shrinking. There are fewer people to pay taxes. Its growth remains sluggish, and its aging society is continually pushing costs higher and higher. Without credible fiscal reforms, these debt dynamics will only worsen. It's a mathematical certainty. And it is interesting to see whether PM Takaichi will even acknowledge this. I wouldn't hold my breath. But here is the really scary part. Japan's troubles aren't isolated either. They sit atop a broader, far more dangerous global trend. The whole world is entering an era where high debt and high interest rates are colliding. It's a car crash in slow motion. For example, look at the United States. I frequently discuss this in my videos because it's so important. The United States now carries a federal debt load of around 125% of GDP, and interest payments are rising faster than defense or social spending. That is unsustainable. Then look at China. They were once the engine of global investment, as you know very well. Now, they face substantial local government debt and a slow-moving crisis in real estate. And if you want to take a look at the EU, you will see that Europe's monetary union remains burdened with nearly 95% debt-to-GDP ratio. This is a level that is sustained only through years and years of artificially low rates. We got addicted to cheap money. So together, the major economies, Japan, the United States, China, and Europe, which are of course the pillars of the global financial system, they now hold the majority of the world as sovereign debt. And that is a major, blinking red flag in an environment such as the one I discussed in this video. This matters because interest rates are no longer near zero. Those days are gone. Central banks have kept rates elevated to control inflation, and the consequences may be quite brutal. Governments are paying more just to service existing debt. That leaves less room for investment, less room for social spending, and less room for economic stimulus programs. In developing nations, these pressures are even sharper. The United Nations reports that 3.3 billion people live in countries where governments now spend more on interest payments than on health and on education combined. That is tragic. And let me tell you, this is something that will happen to the United States as well. That is not an exaggeration. It's math. It is just a matter of time at the pace that we are moving, with soaring debt and rising interest payments that have already surpassed $1 trillion per year. In total, global debt has reached a staggering $337 trillion. Just let that number sink in. And with sovereign bond issuance hitting record highs, markets are growing more volatile, more fragile, and more interconnected. So a shock in one major economy, especially in a giant like Japan, could ricochet across the entire world. And it would hit the United States hard. Arguably, Japan still has some economic buffer. They have external assets, deep domestic markets, and a central bank that is capable of extraordinary intervention if they panic. But the foundations are clearly weakening, and we can no longer ignore it. We just can't. The era of Japanese financial exceptionalism is clearly ending. It's over. And with it goes one of the world's most reliable shock absorbers. We are also losing the United States' reliance on Japan to purchase its treasuries to finance its operations. That safety net is being pulled away. To sum it all up, the world has entered a moment where the margin for error is shrinking. We don't have wiggle room anymore because the global debt crisis is no longer a distant threat. It's not something for our grandkids to worry about. It is unfolding right now. And Japan? Japan may be the first major test of whether the world is prepared for what's to come.